the effect interest rates have on inflation and recession. All right, whenever interest rates are rising or falling, you commonly hear about the federal funds rate. This is the rate that the banks use to lend each other money. It can change daily, and because this rate's movement affects all other loan rates, it is used as an indicator to show whether interest rates are rising or falling. These changes can affect both inflation and recession. Inflation refers to the rise in the price of goods and services over time. It is the result of a strong and healthy economy. However, if inflation is left unchecked, it can lead to a significant loss of purchasing power. To help keep inflation manageable, the Fed watches inflation indicators such as the Consumer Price Index, or CPI, and the Producer Price Index, or PPI. When these indicators start to rise more than 2%, well, between 2 and 3% a year, the Fed will raise the federal funds rate to keep the rising prices under control. Because higher interest rates mean higher borrowing costs, people will eventually start spending less. The demand for goods and services will then drop, which will cause inflation to fall. A good example of this occurred between 1980 and 1981. Inflation was at 14%, and the Fed raised interest rates to 19%. This caused a severe recession, but it did put an end to the spiraling out of control inflation that the country was seeing. Similarly, to combat the rising inflation in 2022, the Fed has been increasing rates throughout the year. Conversely, falling interest rates can cause recessions to end. When the Fed lowers the federal funds rate, borrowing money becomes cheaper. This entices people to start spending again. A good example of this happened around 2002 when the Fed cut the federal funds rate to 1.25%. This greatly contributed to the economy's 2003 recovery by raising and lowering the federal funds rate. The Fed can prevent runaway inflation and lessen the severity of recessions. But here is the most important part of this. The Federal Reserve is always late to the game. Like I explained before, that when inflation moves outside of their 2 to 3% boundary, that's when they start acting. And like they started acting in 2021 when they said, oh, you know what? We're going to get on top of that inflation. This was like December of 2021. They said, we're going to get on top of that. We're going to start raising rates in March or April of the next year. They waited a full 4 months to start raising rates. And in that amount of time, in that 4 months, inflation kept getting worse and worse and worse. And the Fed only started raising little bits at a time. The inflation rate is nowhere near their 2% mandate. As a matter of fact, it's hovering around the 3% range right now, which means they have to keep either raising rates or hold the current rate steady for longer to make sure that people are going to stop spending. But remember, every time this happens, it equates to people losing their jobs, markets turning down, and us moving into a recession. And that's very important. And it's really neat that once you understand how this works and you see when the Fed goes on a long-term raising cycle, you can start getting ready for harder times and you could take advantage of those harder times. On the flip side, when they lower interest rates, which only happens after things look really bad, then, and you know they're lowering, you could start to buy assets for cheap, knowing that eventually they're going to pick up because borrowing's going to get cheaper and people are going to start buying again and stimulating the economy. And you'll be able to sell all those assets that you bought cheap for more. Thank you so much for watching. Let's move on to the next lesson.